and more people will probably be coming in. We are going to be recording this meeting just for future students to rewatch and hear from our alumni. But I'm just going to go ahead and pass it over to you guys, or to the panelists, so that we can just start hearing from them. We're really excited today just to meet with them. So how about William, can you go ahead and start us off? Oh, I think you're still muted.
All right, sorry about that. So my name is William Bryan. I actually went by Bill Bryan back in from 85 to 89 when I was at Cal State Fullerton on a football scholarship. Shortly after that, in 1989, I started working for a company called the Capital Group, started in the mailroom. 25 years later, was regional vice president, left that company and started my own wealth management firm called LPL Financial. And I specialize in working with high net worth investors, small business owners. I do some 401ks and defined benefit plans, but mainly it's wealth management, estate planning, things of that nature. But just to kind of be clear, I went to Cal State Fullerton on a football scholarship from 85 to 89. However, I started working in 89 and I didn't get my degree until 2002 from Cal State Fullerton. I was in the financial planning, economics, degree in economics with emphasis in personal financial planning. So that's a little bit about my background. For the sake of time, I won't go into too much detail on that other than I'm passionate about wealth management and educating young folks on investing. So I'm just kind of going to jump right into it, I guess, and talk a little bit about what I would do if I could go back in time. And it's kind of a good question for me to ask because I'm a student of the game. I study history, I study economics, and I'm always looking back in history and looking at what things were like back in the 80s, the 70s, all the way back to the Great Depression. And I didn't realize it at the time, but when I was at Cal State Fullerton, we had the worst correction in US history, the 87 crash. Market in 1 month, and think in one day, it fell 20, 30%. And it's still on record as one of the worst corrections we've ever had. And at that time, I was a student and I didn't know that. I was studying finance and I didn't know that. To me, the economy was just all about what I was doing from day to day. It had nothing to do with what the media talked about and what the world talked about. So that's an interesting thing for me to be talking about this today with young students. And I would say this, just to kind of start off, when you think of finance and you think of investing, and I know I saw a lot of the questions, I would say the first thing you want to understand and really be able to understand is what are the asset classes? What is the purpose of these asset classes? And I would say it's the capital market is what it is. And a lot of these asset classes in the capital markets were created to allow entrepreneurs and investors to build capital to start businesses. And so with that, Sarah's going to share a slide. And if you could blow that up a little bit, Sarah, so we can see it. I'm just going to kind of summarize some of the basic asset classes and things I didn't know when I was just getting out of college about investing or markets in general. And I would say for anyone just starting out or thinking about starting out, obviously, you want to start with basic savings. And one of the things I always tell my clients and when I do presentations, one of the mission statements of my firm is we turn consumers into savers. And I would imagine that most of you are considered consumers. Those are people that are living off of credit cards. You're not really investing or saving. So we turn consumers into savers, but then we try to turn savers into investors. And once you become an investor, that's when we really want to work with you and turn you from an investor to a high net worth investor. And then from there, my goal is to help you become a philanthropist so that you're now giving back to society and helping others. And if we all had those kinds of things in mind, we talk about legacy and all those things, this would help you get there. So what did I not know that I want to share with you? And if you look at the investment pyramid, you'll notice that I don't know, can you guys see my cursor moving? No?
It's my screen sharing, but I can move mine.
Okay. Yes. Well, you could just kind of follow along with what I'm saying. But if you notice that if you look at the two green arrows going up, as you go up the pyramid, you see you're taking on more risk, but you're also taking on more reward. So that risk reward paradigm is what this pyramid is built on. And so for most young investors, I would recommend you start off before you become an investor, you have to start off as a saver. And when you look at the bottom of the pyramid, you'll see it has savings, T-bills, fixed indexed annuities, money market accounts, traditional indexed annuities. Now, we're not going to go into detail of what these are. Just know that they're the lower risk investments. And the problem with having your money in low risk investments is you're not outpacing inflation. And I'm sure if you're watching the news right now, you're hearing that inflation is running 5, 6, 7% in some cases. So if inflation, let's just say it's 5%, and you're investing in a savings account that's earning 1%, you're losing 4%. But people think that's being safe. Well, you might as well just put your money under your mattress and keep it liquid, because you're losing purchasing power every time you don't invest higher than the rate of inflation. But it's important to start at the basic level, because that's just like keeping your liquidity for an emergency. So you don't want to start investing until you understand your liquidity, your risk factors, and the things that go with that investment. So as you kind of move up the pyramid, you move into, you notice it says conservative investments. And you can see that's where you have US government bonds, you have municipal bonds, you have retirement plans, you have utility stocks, and very, very limited, very conservative investments. Those are typically your stocks and bonds, your conservative stocks or preferred stocks, and your bonds. And I know a lot of you are thinking, okay, well, great, William, but what is a stock? What is a bond? So I'm going to try to quickly help you understand the difference. Let's just imagine we're all entrepreneurs and we have a factory, and that factory can produce widgets. And those widgets need to be manufactured, and we need equipment and we need labor costs and everything to manufacture those widgets. Well, there's 3 ways you can raise the money to do it. You can go in your own pocket, and you can use your own capital, which we recommend most of entrepreneurs, you don't use your own money, or you can borrow the money. And when you borrow the money, you're basically going to somebody else and saying, hey, loan me $100,000. And in return for that $100,000, I will give you back a 5% dividend or income stream every month. That's called a dividend. What I'm talking about is a bond. So when you hear about people issuing bonds, they're basically saying, hey, I have a good business idea. I want to borrow money. And the better quality the business is, the better the idea is, the higher rating that bond gives you. It can be a AAA bond, or it can be a triple D bond. And I'm going to kind of side note, because why is talking about bonds important? Well, I remember back in the early 90s when the markets were struggling, Orange County, one of the most wealthy counties in the world probably, actually filed bankruptcy. And they filed bankruptcy because they found themselves over leveraged or over borrowing, and they extended themselves too much, and they weren't able to make their payments to the people that loaned them money as bonds, and they end up having to default. And that was Orange County did that in the early 90s. So that's why I bring that up. But back to the capital structure. When you're buying bonds, you're actually loaning money to a company. When you're issuing stock, you're actually saying, I want to participate in the upside of your company. Therefore, you don't loan the company money, you buy shares or a percentage of the company. So if you buy 10% of the ownership or 10% of the shares of a company, you now own 10% of that company, and you can vote on it. And that's the difference between being a shareholder and a bondholder. And the last thing I'll say about that is shareholders, on the other hand, if the company's losing money, they lose money too. If the company files bankruptcy, their position gets bankrupt. However, if you're a bondholder and the company's struggling, as a bondholder, you're first in line to get your money back. So I'm not going to go into too much detail. You can see that pyramid, but as you move up the pyramid, you can notice the types of investment get a little bit more sophisticated, probably I would say rarer, especially when you get in speculative moment. And I'll just close out this opening by saying, if you look at the speculative section, there's one asset class that is not on there today. And you young folks probably hear it all the time. And you're probably thinking I'm going to say it, but it's called cryptocurrency, Bitcoin. It is at the top of the pyramid for speculating. People call me all the time and say, should I invest in cryptocurrency? Should I buy Bitcoin? And I say, well, it just depends on your risk tolerance. And when you think of risk tolerance, you're not just looking at how risky is the investment. You need to look at what is your time horizon? What is your liquidity need? If you take all of your money and you put it in an investment and it doesn't, and then you need your money back, if you have to get your money back and the investment's down, you've just created a loss. So risk is all about time horizon and liquidity, not just how much it moves up and down. So with that, I'm going to stop, and that's my opening.
Sweet. Thank you so much, William. Okay, let me go ahead and just see now. We're going to go ahead and pass it over to Natalie. So we'd love to hear from you and just your specific topic that you wanted to share with us today.
Hi, everyone. I'm Natalie Bueno from Bueno & Company. I started my business back in 2017. Prior to that, I worked at Morgan Stanley and for about 4 to 5 years. And before that, I actually graduated in 2012. So it's only been 10 years. It's kind of crazy when I think back, because I used to think, oh, it was not that long ago. In 10 years, I've learned and grown so much, right? So I can tell you guys, just being involved on campus goes a long way. I was very involved with new student programs, student alumni ambassadors, which is who's putting on this awesome event for you guys. And I can tell you, I worked in finance, and I still didn't understand how a 401k worked. I still didn't understand the importance of credit. So the one thing that I wish I had learned pretty early on was credit. That's actually what I do for a living with my own company. I do private investments. And when you see those shows like Flip or Flop or Selling Sunset, and you hear them saying shovel ready, RTI, that's my kind of stuff. That's exactly what I do. I finance those types of loans, development, construction, all that kind of stuff. But again, going back to the very beginning, like 18-year-old Natalie, when I first got out of graduated high school, I didn't know what credit was. I didn't know TransUnion. I didn't know Equifax. I didn't know Experian, right? What's my debt to income ratio? But I'm here to kind of help guide you guys on that, how to start very early on and how to maintain credit. You hear all the time that there's these myths that, oh, don't use a credit card. Don't open up a credit card. You're just going to get into debt. And then you're going to basically, ruin your credit score. Well, you'll ruin your credit. You can't have credit unless you open up something, but there's a way to do it and be responsible about it. So yeah, if you guys have any questions regarding credit, how to start it, how to build it, that's what I'm going to be here for, to help out with and help answer those questions.
Sweet, awesome. All right, now I'm going to go ahead and pass it over to Vincent, and we'd love to hear from you.
Awesome, thank you. My name is Vince Coe. I am a second generation Fullerton graduate. Both of my parents went to Cal State Fullerton. I actually stayed in the same apartment across the street that my mom did back when she was in college at Fullerton. So long history there. I've actually graduated from Fullerton twice, once in 2003 with my undergrad, similar to William, went through the personal financial planning track. And again, in about 2012, doing my MBA. So great source of knowledge that came out of Fullerton. Happy to give back here. I've basically spent my entire life, work career life, around investments. Right out of college, spent about 7 years specifically focusing on school employees, or as an employee of, you might have noticed the name Octafu, Orange County Teachers Federal Credit Union, now known as Schools First. I was with them as they kind of developed their 403B practice, basically running the retirement programs for most of the public school districts in Orange County and LA. And from there, I'm now at a company called Precept Advisory Group, and I focus all of my time dealing with corporate retirement plans. So things like 401ks. It's kind of the most boring out of all the investments, but it's probably the most important. I wanted to make sure that the work I did had the biggest scope in helping people, not just one person at a time, but with as many people as possible. So I work with mid to large size companies. Many of them are household names. You probably use their services, but since we're recorded, I'm going to keep those names to myself for now. But yeah, as we go into it, that's kind of my topic. And as you think about retirement, a lot of times when you think about investing for retirement, it sounds like an old people's conversation. And I want to not only reassure you, but try to give you that nudge to say it is not an old person's conversation. The better job you do at preparing for retirement in your 20s and even in your teens or early 30s, the easier time you're going to have of it as you get closer to that goal of retirement. As William said, time horizon is such a big thing. When you're 20 years old, you've got 40 plus years to invest these dollars before you're ever going to need it. That means you got a lot of risk that you can take on, a lot of potential reward. And if you do that right, you do it early, it's so much easier. But as you guys start heading into the workplace, I think you're going to be faced with two major questions. First being, how much should I save? And I know when I was even just going through the financial planning track, That was kind of a hard and nebulous question. No one really had a good answer for that. There's been a lot more studies, a lot of academic work behind that. And if I could just put one number in your head, try to get to 10 to 15% of your income locked away in savings. I don't care if it's your summer job. I don't care if this is your part-time internship, you're just getting started in your career and you're thinking, I'm only making 15 bucks an hour. Why, how is this even going to help me? Every dollar counts. Get in that habit. Every paycheck you get 15% into your 401k or an IRA, one of those fancy three-letter words that's tied to retirement. That's going to get you set up. If you're doing that, I almost don't care what investment you choose. The fact that you got money in the game means you're going to have a better time of it once you get a little bit more knowledgeable and you're able to start making those educated decisions about, hey, should I buy more bonds? Should I buy more stocks? Do I want to, buy GameStop or any of these companies you hear about in the news? Start saving early. It's going to help you a long way. I think the last thing I'll touch on before I hand it off, I do get a lot of questions about Roth versus traditional investing. You'll see it as you start entering the workplace. Roth is a great idea. The whole way of saving for retirement is tax advantaged, but we get a choice in how we get those tax savings. So we can either pay all of our taxes up front today, or we can save them for later. There's no special tax bracket when we get older. Y'all know as you make more money, the government takes more of it. So when you're just starting out in your career, that's probably the least amount of money you're going to make in your professional development. So your taxes will just get worse. It's going to get more complicated. The nice thing about a Roth is it's after tax. Pay your tax now while you're young. Don't worry about it when you're older. And as you get more sophisticated, you learn about your career, you're going to make more money and you can start making changes down the road. But if I can just keep that in your mind, start at 15%, just save as soon as you can. So Sarah, I'll pass it back to you.
Awesome. Thank you, Vince. Okay, sweet. And now we're going to go ahead and pass it over to Laura.
Yeah, absolutely. And Vince, as you were talking, I was thinking, man, I need to take this advice now and get an Roth IRA going. So very excited to be on this panel and also learning from all of you. So as a quick intro, hi, my name is Laura Romine. I graduated from Cal State Fullerton in 2017. And as during when we were getting to know you, mentioned, I would say Cal State Fullerton is basically what got me started on the finance track and where I am today. I cannot speak about it highly enough. I had an amazing time getting my degree at Fullerton. And one thing that really impacted me was doing at the time it was called the Applied Securities Analysis Program. Now it's called Titan Capital Management. So if you have any interest at all in investing, I would highly recommend that. There's also a feeder program, a student managed investment fund. So just a very quick plug for those programs if there's any interest in this audience, or if you have any friends who are interested in investing and want to bring it up. That really got me on the track of thinking about markets, thinking about what's going on. So reading the news more, trying to understand kind of how financial markets play into the way that society is organized today, and just my general interest in curiosity and understanding the world. Then post-grad, I ended up working at PIMCO for 4 years. And then now I'm actually currently back in school as a student, getting my master's at HBS. But at PIMCO, I was covering credit, a bit different from the credit that Natalie mentioned, and not to try to confuse the audience, but thinking about financial markets and how when you invest in these different types of funds, those funds hold securities that companies issue, as William mentioned, stocks and bonds. So I was looking at primarily the bond markets and thinking about what changes those prices and asset valuations, and in terms of how that ties out to you, basically how you're able to accumulate wealth through companies earning more profits and the prices of their stocks and bonds rising. So about 2 years in, I was starting to feel a little less maybe just excited generally about the finance aspect. And so I also got involved in our ESG efforts, which is environmental social governance. And it's basically trying to make decisions not only based on which companies do we think are the most profitable, but also which do we think are doing the most for society, particularly looking to reduce carbon emissions, or on the social side, companies that are committed to better hiring practices, more diversity, looking to pay a fair wage, and thinking about their supply chains. So really that's been the angle that I focused on in the last couple of years, and what I'm looking to do going forward. And I'm looking to stay in financial markets generally, but potentially also on the venture capital side. So if you have any questions around investing, different types of we already talked about risk tolerances, but venture is kind of a way to invest in newer, smaller companies versus public markets where you're investing in larger publicly traded companies. And I might be getting a little too in the weeds right now, but yeah, I would say like sustainability, financial markets, and also just the angle of being a student. If you have any questions around those, happy to help or try to help.
Awesome. Thank you so much, Laura. Very well said. So yeah, now that we've all introduced ourselves and just gotten to share a bit of your guys' backgrounds and some information, I'm just going to open up to all of the people in the Zoom. If you guys have any questions, you guys can either unmute your microphone or type it in the chat and I will read out your question. Don't feel afraid. There is no dumb questions, you know, all questions are valid. And we'd love to hear from you guys. I'll go ahead and start us off with the first question. And this might also answer somebody else's question, but if I'm a student at Cal State Fullerton and I'm making a minimum wage job, but I'm excited and interested in investing, how can I start? What companies should I look at? And maybe that's broad enough that you guys can answer that question.
William, I think you might be on mute.
I'll expand on what I started talking about as far as risk. If I had a chance to do it over again or to help people start from the beginning, I would recommend that before you even start investing, you first learn how to create a budget and manage a budget. And after you've learned how to manage a budget, I would recommend you learn how to be a saver. And once you've learned how to be a saver and you're not living paycheck to paycheck, then you can start investing. Now, if you want to invest because you enjoy gambling and taking a lot of risk, that's a different thing. But if you're seriously about trying to invest, I would recommend you save first, make sure that you're comfortable with that. And because once you start investing, everything goes up and down. And you put your money in the market, and then next thing you know it, you need it back for your rent next month, but you just lost 20%. So I would say until you're saving, until you start with your 401k and your Roth and your IRAs and all that, I would stay away from investing. Don't get caught up in the media hype with buying blockchain and putting $20 in and buying GameStop and all that kind of stuff.
I would completely agree. And, you know, budgeting sounds boring. It doesn't sound very exciting and it sounds like a lot of work. And I'll be honest, when I started working, it was. We didn't have a whole lot of technology back then. You had to open up an Excel workbook and just start plugging away everything you had and hope you did it right. There's a whole lot of companies out there that will help you budget. Most of them are free. You can look at things like Mint. You can look like, you know, almost any financial company. Most banks out there offer budgeting software. I'm not going to say one's better than the other, but they're all available. It's all out there. And that's the most important thing. Get your budget in order. If you don't know what you're spending, there's no way you're going to save. And then get that emergency savings going. You know, most of America does not have enough money to go more than a week or two before they have to start tapping into their credit cards. Don't be one of them. You know, there's no point in talking about investing if you can't even meet your daily cash flow needs. So have that emergency savings. You know, we've kind of learned that through COVID, through the pandemic. Life is radically dynamic. You can never, even if you think you know what's happening tomorrow, you can never depend on it. So get that emergency savings going. And then, yeah, I would agree. Once you've got the basis taken care of, then you could start talking about having some fun, but know what you're saving for, right? Do you have a goal in mind? Are you buying a car? Are you buying a house? Do you have that taken care of? And now you're just investing for fun, for some vacation down the road, or you just want to start growing this nest egg that you have. Know why you're investing, and that's going to help you determine what you can invest in.
I couldn't agree more. Just to tap into it, I'm an app person. I refuse to do flyers. I refuse to do like notes. I have like an e notebook where I record it and scan it. I will say Mint is phenomenal. It actually helped me budget because I'm trying to buy for my own real estate, right? And even though I'm in the industry, I still need to know how much I'm making, right? How much I'm spending, not only from a business standpoint, but I also need to know it personally. So Mint is fantastic. If you guys want to download that, that's a great way to start. Another one is Credit Karma. If you don't have credit or you're not even familiar with credit, Credit Karma is an excellent way to at least start monitoring your credit growth. Now, don't be alarmed, because if you have no credit, and your parents didn't put you on a credit card to help you start, or if you didn't open up a credit card yet, it's okay. You're all still very young. You can build credit pretty easily. I know some of you may be, I think with credit cards, it's going to take more knowledge to understand, like, okay, what's my balance, right? What's my limit? I think credit card companies are the biggest scam. They give people like me way too much credit early on. I mean, I had $1,000 credit limit for Target that I did not need when I was 18 years old. So be very mindful of that and just tell them, hey, I only want like a $300 limit. I only want a $500 limit. They may approve you for more, but if that's what you're comfortable with, that you know you could pay back $300 in a month if you needed to, that's how you have to look at it from a credit standpoint. And the other biggest piece of advice that I can give if you're just an entry level getting started, start watching CNBC. Watching CNBC truly changed my life in terms of keeping up with financial news. I don't watch regular news anymore because I don't need to. The financial networks tell me what I need to know, what's going on in the world, right? And if you're constantly going to sit there and watch, you know, TMZ and all that stuff, I get it. Those are fun and entertaining. But CNBC will actually help you keep up with your financials in whatever profession, and it'll keep you up. It'll help you keep up with world news as well.
Great. Yeah, great advice, you guys. Thank you. So the next question is, what is the best mindset to have as adults entering the workforce after college and managing a budget that is geared towards generational wealth and long-term investing? So maybe this is for the person who kind of has a good grip on their saving, they're getting that first big girl, big boy job, you know? And so how would you guys answer that? And I can ask it again if you'd like.
I'll start with the first part, you know, taking care of the basics, the boring stuff, right? As long as you got that 401k taken care of, you're going to start hearing about things like HSAs and different ways to save that could be advantageous for retirement. But let's assume you have all of those basic needs taken care of. That's where the fun starts to begin, when you have a little extra money to start to deploy, and you can start to think about, do I want to start saving for a house and get into the real estate market? We're all in Orange County here. It's expensive. It was expensive 5 years ago, 10 years ago, and 15 years ago, and it's even more expensive now. So it's a question I think you're going to tackle with your whole life, because that real estate market just probably won't settle down. It'll continue to have its ebbs and flows. But do I want to save for that? Make sure I can get into some sort of property and call it my own. Do I want to just start investing in general? And that's, I think, where, you know, someone like William is going to be able to step in, right? That's William's job, is helping people with that question in mind, figure out their needs, and help them deploy that capital. So William, I'll pass it to you.
Great start. And I would say a ditto to what Vince said. I would add to, you know, when you start with your 401k plan, the good news is if we live in California, starting this year or in June, companies with more than 5 employees must have a mandated 401k plan. So if you're working in a real job, you're going to have access to a 401k plan. So you want to first find out, are they matching? And if they're matching, you max out at minimum what they're matching, because that's a 100% return. If I told you all, come on this call today, and whatever you have in your pocket, I'll double it, you guys would have all filled your pockets up because you know I'm gonna double it. Well, that's the same thing as a 401k. So it really starts with that. And then once you've maxed out your 401k, you got your budget in place, you understand your emergency needs, your liquidity needs. Now you start to look at your discretionary income, and now it's lifestyle. What type of lifestyle do you want now versus what type of lifestyle do you want in the future? And as a wealth manager, I always tell my clients, my job is to help you see future liabilities. And those future liabilities can be anything like what Vince said, from owning a home to long-term care. You guys are too young to even think about that. But if you have older parents, my generation, we're called the sandwich generation. And most of the people in my age, I'm in my 50s, and most of us are constantly trying to figure out how to take care of our parents and our kids. And so it's challenging. And if my parents had long-term care, it would save us a lot of money. So those are things that a wealth manager or financial advisor would help you with. And one of the things none of us have really said, but I recommend, when you get to that level and you're thinking like that, I would recommend you get a financial professional. I know a lot of people say, oh, I could do it myself, but you could do your own heart surgery. You could be your own doctor, but you don't because it's serious. Well, retirement savings and investing and buying real estate, those are going to be the most important things you do to create generational wealth. And then the last thing I'll say on it is understand the power of compound interest. It's time. And you got to really think long-term. Don't get short-sighted. I know Natalie mentioned CNBC. CNBC is good. For me, it's entertainment. I actually record it and I actually watch it at the end of the day after the stock market's closed, because if I'm planning ahead and I'm making a decision 5 to 10 years out, I don't want to make an emotional change based on what they're saying for day traders on a daily basis. But that's a whole different conversation. You'll grow to that. And then the last thing I say is the secret to it all, real estate, 401k, stocks, you guys all should have a pencil and a piece of paper. This is a powerful message I'm going to tell you right now. Buy low, sell high. That's it.
That goes for real estate too.
Right.
So, I mean, and you guys can see that. I just want to just piggyback off of that because, the biggest piece that I see, a lot of people, I've seen it from both sides, right? I've seen a lot of people build their 401ks, when they're starting out. I max my 401k match. I did that because I was told to do that, right? But if I hadn't been in that industry, I don't know if I would have, right? And I had a budget where I would, I didn't have all these apps even in 2012. I had a little Excel sheet. It was boring, but guess what? It was just like managing my classes. I had to manage the money, right? Because my parents weren't paying for my rent. My parents weren't paying for my furniture that I had to furnish for my new apartment when I moved up there. So I would put like I would go to Home Goods or something and I would know, okay, I can't afford this little couch that I want to buy just yet, but I know that I get paid this much every 2 weeks. And if I can put this money, like $100 away, I can buy that $500 couch, within a month or two. So it's like the little things. I looked at it back then and I'm like, wow, I can't believe I was budgeting even then without even realizing it. So it goes a long way. It's the same thing with buying a house. I just did the math right now. If some of those condos, little 1-bedroom, 1-bath condos in Fullerton, I get it. That's not really where people want to start. And I tell this with everybody I work with. The first home is usually not the dream home. Okay. The first investment is usually not the first, your forever home. And that's okay. But a $300,000 condo would require as little as $15,000 down. Okay. So that's something to think about because some people get really like discouraged and they think they have to come in with 20% down. There's even programs out there where you can come in with 0 down. Now, again, does credit play an important part? Absolutely, right? Does your budget and your debt to income ratio play a huge part? Oh, that's a whole different story. But debt to income ratio in mortgage really goes back to the basics of savings, right? How much are you spending? How much are you saving? So as much as I was like a big spender in college and I loved going to Vegas and I would work 3 jobs, whatever I needed to do to go have my fun. And my aunt would always call me and she'd say, hey, you're working the weekends this weekend? I said, yeah. She goes, you either got a parking ticket, or you're going to Vegas. Which one is it? And we would laugh because that was literally what I would go work that side income for, right? And so, I look back at it now, but I understood that I couldn't go and have my fun based off of my current income. So if I needed that to make extra money, then I was willing to go make some extra money. So it's one of those things where you have to understand where you are financially, and you have to be able to understand that these are my essentials, right? This is my semi-essentials, food, gas, whatever. And then you go from there to the fun and I would say the investment. I wish I had invested a lot more. So investing, and then of course the leftover for fun.
Yeah, Natalie, I'll hop on top just with a personal anecdote. As you're talking about that 300,000 1-bedroom place, that's exactly how I got into real estate. My first property that I bought, I actually stayed home with my parents a couple extra years, kept all of my income as savings, And that wasn't that great for my dating life, bringing people home to see your parents. It's not always exciting, but it gave me that extra 15 to 20 grand I needed to get that down payment going. Stayed in that 1 bedroom, 800 square feet place. It wasn't that great down in Laguna Hills. But guess what? I held on to it when we eventually moved out of it 7 years later. I still have it. It's a rental property for me now. It generates income for me. That's, as we're talking about, how do you keep an eye on generational wealth? It first started as kind of a savings block, right? Instead of paying rent to someone else, I just wanted my own place. So I'm paying rent to myself. Kind of boring. But now, so many years later, that generates income. That's helping me pay for my kids' activities, fund money for me on the side, whatever I want to do with it. And it kind of got us on the journey of home ownership. And so now we have multiple properties, and that's how you get started, step by step.
I love hearing that because like I said, I see it a lot on both sides, and I get a lot of my private loans because people don't invest in stocks. They don't invest in 401ks, but all they have is real estate. And that's worked for some people, but I wouldn't recommend it because you really should have a diversified portfolio. And, William and I met with Sarah last week just to go over, because we couldn't make the other meeting. And we were talking about it because it's such a huge, you got to learn, and we said this in the very beginning, you got to learn how to save first before you can start investing. I mean, that's really what it comes down to. So that's awesome, Vincent. I love hearing that type of story.
And it looks like we have a few questions here. So I'm going to hop into this one. It says, if my company is matching only half of my 401k up to 6%, should I still match the 6% or invest it somewhere else? So I don't know, Vincent, if you want to take that.
I would say use that match as a stepping stone to get you to that 15%. I really don't care if that money goes into your 401k or an IRA. The best thing you can do is look at the costs. If you work for a really small employer, there's a very good chance your 401k is very expensive. So it might be better for you to just put the rest of your savings in an IRA that you set up on your own. Go to Schwab, go to Fidelity, go to any of these companies. They have very dirt cheap IRAs available for you to use. If you work for a really large organization, let's say a Boeing or something like that, their fees are so low compared to what you can get on the retail space. It'd be kind of a waste not to use those. So they all have, they're required to send you, anytime you get a new job, a fee disclosure. You can look through those. I know it's not always easy to read. And if you can't really figure that out, you can always get professional help. But if for whatever reason, you really don't get it, you're not getting the professional help, you can just make the first educated guess. Do I work for a mega sized company or not? And that'll help you decide, should I just continue the rest of my savings with my corporation or just on my own in an IRA? But the mistake I see a lot of people say is, I don't get a match at work, so I'm not going to save for retirement. It has nothing to do with your ability to save for retirement. That's just a bonus. That's just a little less money for you to save. Your goal should always be to get to that 15%. Yeah. William, do you have something to say?
Yeah, I would add to what Vince said. If you think about compounding interest and how it works, if you're in your 20s and you at minimum you max out your Roth IRA or your IRA for 20 years, you will, and you stop contributing to it, you're only going to be in your 40s. By the time you're in your 60s, you will have close to $1 million if you've done it in just decent investments. And that's, if you think of cost of living 40 years from now, that may not be a lot, but by the time you guys start investing in your IRAs and Roths, the annual limits are going to go up, so you could do more. But I'd also say, if you work for a company, and Vince, you correct me if I'm wrong, if you do work for a company that offers a 401k plan, you might as well just go ahead and stick to the Roth. Keep it simple. Do the Roth, because your IRA will not get the tax deduction because you have access to a 401k plan that can get tax deductions. So do the Roth. And the advantage of that is, as you make more money, you will eventually not be able to contribute to a Roth. So you want to do it while you can. And just to emphasize why that's such a big deal. When you're later on in life and you're retiring and you do a good job, you're now in your 60s and your 70s and you're taking income. Well, if you have millions of dollars in your retirement plan, when you take it out, there's a thing called RMDs, required minimum distributions. And you're going to have to start paying that regardless of if you need the money or not. And the reason why you got to pay it is because you got a tax deduction 20, 30, 40 years ago. Now the IRS watched it grow to $1 million. Now the IRS is saying, we want our money. You're going to take it out regardless if you need it, and you're going to pay taxes on it. So the advantage of doing the Roth, because you've already paid the taxes, is now you're in your 60s, 70s, 80s. You take that money out when you want to, and you don't have to worry about taxes. And if you're taking out $100,000 a year in retirement, your taxes on that IRA could be $30,000. So just kind of think, well, so we talked about wealth and generational wealth. It's all about thinking about your future tax liabilities, not just next year's tax liability.
Okay, great. Thank you. Okay, and we have a few more questions coming in, so I'm excited. For non-finance students, do you guys have any books or resources that you'd want to suggest to start a basic understanding, kind of just develop some of these concepts you've already brought up today?
See William grabbing something. There you go.
Sweet. Personal Finance for Dummies. That looks great.
I will also say, investing today is more than the numbers. The numbers are the easy part. You can go to a book, you can go on website, you can go anywhere, and people can talk to you about how to invest, where to invest. The number one thing that gets investors in trouble is their emotions. And there's a company called Dalbar. You guys, I don't know if you've heard of Dalbar. Dalbar does a study on all different industries. They rank investors, they rank businesses. Well, they do a study about the average investor, those who are investing $1 million or less, and they look at 20-year periods of time. And they find out that the average investor only gets 1/3 the return of the stock market they invest in. And when I share that statistic with people, most people think it's because, oh, these other companies are charging high fees. Oh, they're making bad decisions. Well, no, it's because, and Sarah, if you could put that emotional clock up real quick, and we got time, I'll do this fast. It'd be easier with that clock. So while she's pulling up the clock, I want you all to think about what's going on right now outside in the real world. Stock market's crashing. There's a big war. There's political unrest. There's social unrest going on around the country. We're just dealing with COVID. Companies are having problems hiring people. All these bad things are going on, and we know the stock market is down big. How many of you, I don't see your faces, so I can't get show of hands, but how many of you think that this is a great time to invest? The reality is, yeah, it's the perfect time to invest. So this emotional clock breaks it down. The reason why, if you look at this clock and you look at imagine 6 o'clock, 12 o'clock, 3 o'clock, 9 o'clock, so imagine the clock. And if I were to ask you all, based on what I shared about what's going on today, what time are we at right now? Are we at 12 o'clock, or are we at 6 o'clock? Are we at 3 o'clock or 9 o'clock? That's the question. And the problem is we know we should buy low. So we want to invest. Yeah, we're probably, some people think we're at the top. Some people think we're at the bottom. But the reality is we know we should buy low and sell high. But the story I told about how bad the economy was, that's what it feels like when you buy low. When you're buying high, if we got on here and we say, oh, the stock market's at a record high, there's no wars, everything is going great, everybody's doing good. Nordstrom's just had record sales. Everybody's buying Teslas. Elon Musk didn't buy Twitter. We heard all these great things. That would be the market high. That's not the time to invest. But what we do is we wait till the market goes down. Then when it starts to rise again around 8, 7, 8, 9 o'clock, we hear about the success stories of everybody else. Then we jump in the market at 11 o'clock. We ride it up a little bit with expectations that we'll keep going up. And then it starts to go down, and we hear all the bad news from 1 o'clock to 2 o'clock to 3 o'clock. And then at about 4 o'clock, we make the emotional decision, I can't take it anymore, and we get out. Then when we feel good, we get back in. And that's why investors don't do good long-term, because we do pay attention to the noise and we don't pay attention to our plans. So I just suggest everybody take emotions out of it and hire a financial professional to help you keep the emotions out of it, and you'll be successful.
I actually, what you were saying, William, kind of reminded me of my initial investment strategy. I wouldn't necessarily recommend this to everyone, but something that I got started when I first started having like a consistent paycheck, and I knew I could allocate, I think it was just like a couple $100 every paycheck to invest. I just had it go straight into like an S&P index fund, so that it was like I set that up. There was a way to do that somehow with like the investment account that I had set up, where it was like an automated thing. And so I didn't even see that money every 2 weeks, you know, when the money hit my account, I didn't even see the couple hundred that went away. And like, I wasn't even necessarily checking that all the time. And then after a while, you know, it started to build up. So it was just a S&P index fund. So it was just holding a passive version of the 500 largest companies. And I think that really worked well from the level of like, I wasn't trading. I wasn't thinking about where asset prices today. Do I want to buy in? Do I not want to buy? I was just buying and then I also wasn't necessarily like, it wasn't hurting me to lose the money each time because I wasn't even seeing it.
And that's called dollar cost averaging, DCA, or dollar cost averaging. And when you invest in your 401k plan, you're automatically doing that every month. That's why Vince said it's so important to start there.
And that's where we, draw the line between investing and gambling. You always have to remember both investing and gambling deal with the stock market. You could buy the exact same thing, but the reason why you buy it and how you approach it splits the difference. And there's no problem with day trading, but that's gambling. So if you are going into the stock market, you're seeing AMC, you're seeing GameStop, you're seeing all these fun stocks that are hitting the news. You want to buy into it? Make sure you treat that as if you're gambling and you have that budgeted as a gambling expense. I do that with our own family dollars. We have a certain amount budgeted per month that we're allowed to just buy whatever stocks we want to. And have a financial education, able to read balance sheets with that money, I don't care so much. I'm not going to look too deep behind the hood. I'm going to look at something fun, and I'm going to go into the mindset that I don't expect to get this money back. This is absolutely just fun, but I've budgeted my dollars. I know if it's gone, no harm, no foul. If I make something, great. It's like I bought a lotto ticket, but I'm not going to expect to get any returns. I'm not, if that money goes away, it doesn't mean I can't buy the car I needed. Doesn't mean I can't buy the house I wanted. Doesn't mean I'm not going to retire on time. It's just fun. It's like buying a movie. So make sure you separate those two in your mind when we start talking about investing and allocating your investments, your hard-earned dollars into the stock market.
Awesome. So I'm going to jump back in. There's a few more questions. And so maybe, Laura, you might have just answered this question, but it was about what advice would you give a student who may have some money ready and saved up that they were considering investing? So maybe in the 1s, 2s, like 5,000 area. And you talked about an index fund. Is that where you would consider like starting for a first-time investor?
Oh man, I would probably punt to one of these guys. I don't have the right credentials to really provide investment advice, but I do. I just wanted to, Claire's the most recent, how can you predict the value? I was going to say, if you can do that, then please let us all know for all of the ones where you can do that, because we will all go buy immediately.
Yeah.
That's what we're really trying to do. But sorry.
Yeah, I would say that goes back to what we talked about with budgeting. You can't really have somebody tell you how much you should invest. I'm going to start with that part of it, because I don't know your budget. If I knew your budget, then I could help you make that decision. Because if you say it's $5,000, well, what if you need it next month? So it really comes down to your discretionary income, your goals and objectives. And I would say, like Vince said, if you're just doing it because you want to learn, treat it as gambling, and then if the question were to be, William, I'm going to Vegas next week, how much money should I take and gamble with? Well, this is almost what you're asking us, right? So that's the same concept. So don't look at investment for wealth building and long-term success the same as you do gambling. But if you want to gamble and play the stock market for fun, that's a whole different game. And to the question about how do you know when a stock is going up or down? Well, that's what professionals do. That's what research analysts do. And if you don't know how to read financial spreadsheets, balance sheets, technical analysis, and all these things to determine an investment future outlook, I would say you're gambling if you buy it, unless you go to a professional who knows how to do that. So stick with mutual funds, stick with index funds versus, and let me just say this, because I know this is one of the questions you all had. there are two basic types of mutual funds out there. You have index funds and you have actively managed funds. So what are the differences? An index fund is basically a mirror of the S&P 500. As an investor, you can't go out and buy 500 S&P stock easily. It's going to take too much time. So you can buy an S&P 500 index that has all S&P 500 stock in it. Some of them are weighted equally as the S&P. Some of them are equally weighted where everybody gets the same amount, but that's an index fund. A mutual fund that is actively managed may have active managers who actually go out and research, they kick the tires, they may go visit the CEO, the CFO, they may go see the competition, and they decide, well, maybe we'll buy AMD, but we won't buy Nvidian because we like 3-year outlook. And they'll put it in their portfolio. And then there's all levels of mutual funds. But if you're asking, how do you know the future value of a stock? I would say stick with mutual funds till you learn that. Because otherwise you're just taking risk, undue risk. And that's what's happening right now in the market. There's a lot of investors who are buying investments that they think they're investing in, but they can't predict the future value. They're just guessing. And so I say that's the big difference between trying to be a prophet and trying to use wisdom. Wisdom, you know, if you see a chicken, you know it's going to lay an egg and you know what's going to come out of that egg. That's wisdom. But if you've never seen a chicken and you've only heard of chickens, and then you see this egg and you've never seen an egg, you've only heard of eggs, and then you predict what's going to come out of that egg in five months or whatever, that's speculating. That's trying to kind of be a prophet and trying to guess. Don't do that. Stick with what you know and stay with wisdom.
Well said. One question here, I think it would be really great. All right, maybe one more just popped up. It's if folks are still feeling overwhelmed by finances, how do they go about asking for help? And what can they say if they're feeling embarrassed of where they're starting?
www.whbfinancial.com. You can ask me any question at my website, and we'll respond. And we actually have quarterly calls. We have meetings where we kind of go in detail about all these topics. So feel free to go on there. It doesn't cost you anything. Anybody that went to Cal State Fullerton can get all this education for free.
Yeah, that's awesome. And I'll be sending a small little PDF with all of our panelists' contact information, and as well as your website, William. So I'll send that out before the meeting ends, which is great as well. Let me see.
On the point about like being like embarrassed, or I guess just maybe not necessarily advice, but I would really want to like assuage you that you don't need to be worried about that. I was working like at a big financial firm for years, and I was like at the beginning surprised, and then I just really started to realize this, like people often like, or a lot of times like do actually not know what they're talking about. And so when you really like dig in and ask them deep questions, like you'll find that sometimes like somebody who's even in the industry, their knowledge doesn't actually go that far. And so you're thinking like, oh, as like someone who isn't doing this on my day to day, like I don't know enough, but you probably know more than you think you do. And other people might honestly know less. So I would really encourage you to like not be intimidated. Like, don't be scared. I actually think it's super brave to come from a place of like, hey, this is something I'm interested in. I don't totally get it right now. Like, can you help? And then if that person is able to help, then that's great. And if not, you find someone else.
I can just say, from somebody who works with real estate agents, lenders, like different, I work in an industry where, name brands are really big, right? Who's got the best watch, who's got the best car, who's got the best purse, everything. Let me tell you, it was kind of tough because in the beginning, when I transitioned from Morgan Stanley, I had bought some nice pieces. I'd invested in a nice wardrobe, like a little couple things. But, what I wish I had done is what Vincent did. I wish I had stayed home longer, right? I was paying the expensive rent in San Francisco. Rent did me nothing, right? And I get you want to maybe live on your own and have some freedom. I recommend that, but be smart about it, right? Or live at your parents', or live somewhere else where you can really budget and save. I came back home from San Francisco and I was living at my parents' house using my old Jetta that basically, was paid off and free and clear. But everybody was like making fun of me, like, oh, look at her car and this and that. Well, guess what? A lot of the people's loans I did, they had Porsches, they had Maseratis, but they were in debt, trying to prove to everybody that they could afford a Porsche or afford a Maserati or a Tesla or whatever. So never ever put yourself in that position. No matter what industry you're in, it doesn't matter if your friends like, oh, this is the new Nike. Oh, this is the new, you can't go to Coachella. Why not? Never let them pressure you into getting into something that you can't afford, right? Be smart about it. Be realistic about it. Stay true to the budget. Stay true to the long-term goal. Because let me tell you, they made fun of me for having that car, but I was free and clear, very little debt on that. I mean, on the insurance that I had to pay for. And now I have my nice new car that I was able to get a 2% rate because my credit score was amazing. I have a 5-year loan on it, and I'm happy with it, right? So, but it took me understanding that that was my goal to budget. And it's the same thing with my investment with real estate. I have to go look at the property tomorrow, know how much work I have to put into it to fix it up. All of that requires how much money I can save to go ahead and do that. Did I have to pass up on some Louis Vuittons? Of course, right? But it's okay. We have to understand that this is what we have to do to get where we want to be.
Awesome. So well said, Natalie. I really appreciate that. And yeah, just as we kind of wrap up here in these last few minutes, are there any like closing comments or just kind of like what Natalie said, like encouragement in that direction, just to kind of close out this meeting tonight?
Well, I guess not. Go ahead.
I was just gonna say, like, do please feel free to reach out. Like, I know that can be intimidating as well, but you all are now, you have a connection with all of us. You were here at this panel, so you could definitely always reach out and be like, hey, like I saw you at the panel, I have some questions, or, especially like as you grow in your careers, and networking can be huge. So just wanted to like plug that because I wish I had started reaching out to people sooner.
Yeah, and I'll say I love this. I love talking to students and young professionals, which is what you guys are. And if you guys would have us back to do more focused topics, to dig deeper, take deeper dives, I'd love to do that. And just remember, at the end of the day, it is about buy low, sell high, and it's the emotion that will drive the right decision. And you got to learn to take the emotions out of it. And remember compound interest, and understand the risk you're taking, and don't listen to the news because they will make you crazy.
If Kramer tells you to buy something, walk away.
Yeah, I remember back in the day when before the 2001, before 9/11 and Enron, just to kind of close out, just a thought. Enron was the #1 selling stock on the market in 2001. And everybody wanted to buy it. The company I worked for, Capital Group, managed trillions of dollars, and we didn't own any because we are a research-driven company, and we did our research, and we just couldn't see how Enron was making all that money. Well, for 3 years, I had to listen to advisors tell me that we've lost our touch, we're dinosaurs, and we don't know what we're doing. Then when 9/11 happened, and then Enron crashed right after that, it was back to fundamentals again. And for years, we had to listen to the noise. And then I also say, we all heard of Bernie Madoff. Bernie Madoff ran a Ponzi scheme for over 20 years before he got busted. And so just because it's a Ponzi scheme doesn't mean it's going to get exposed today or tomorrow. So when you start hearing about cryptocurrencies, if you don't understand how the value is being created, it's like the saying, when you're at the poker table and you don't know who the fool is, guess who's the fool? So just keep that in mind.
I just put in the chat to connect with us on social media, LinkedIn, all the above. I haven't checked my LinkedIn in so long, and I went back on there. Guys, we have so many alumni in so many different areas. Please, please, please connect, stay connected. I promise you, I constantly am still connecting with alumni and people who know people to connect me with different things. So whether it's regarding finances, jobs, whatever it may be, take advantage of our network, guys. Take advantage of our awesome alumni network.
Yeah, and just piggybacking off of that, Natalie. So yeah, on the PDF I sent to the chat, there's pretty much everybody's LinkedIn. We also have William's website. And then I think Laura just sent her email. And then we also have Titan Pro Network. If you've never used Titan Pro Network, it's a really great website that's specific to connect different Titan alums together. And you're able to reach out. I was able to both reach out to Laura and Vince in order for them to join this call. So it worked out really well. And so take advantage of those resources that Cal State Fullerton has to offer. And so, yeah, we're right at the dot. So we're going to go ahead and end the meeting. So thank you so much to our panelists. Round of applause. You guys are incredible. And so we'd love to have you back in the future to do more events, go in deep and hear more about your guys' journey. But thank you for everything that you shared with us today.
Thank you.
Here, thanks so much for putting it on.
Sweet. Yeah,
Thanks,
appreciate
Sarah.
it. Yeah, you're welcome.
Everyone, go Titans.
Woo. All right.
So-
Bye, guys.